Okay, you've read the title. You know, I'm talking to the man himself, Rick Roll. So we can forget about the introduction. That's not needed. But I won't forget to tell you though that this discussion is going to be general and impersonal in nature. Its only goal is entertainment. I like calling it. So you should also know that we might be biased towards the investments that we are about to discuss, as we likely have our own money invested in them. So that's a fair disclaimer too, I think. And also that neither of us is a licensed financial advisor. So do know that. By the way, you also have to pause the screen right now. There's a big disclaimer on there. Read it, unless you like losing money. And when you've done that, I will finally welcome my guest here, Rick Roll. Sir, thank you for investing in time with me today.
Pleasure. Thank you for having me back. I enjoy these sessions.
Oh, absolutely. And the pleasure is all mine. It's been a while since we spoke. So I thought I'd reach out, and I did. And you know what? I've noticed this. And I prepared I envisioned myself saying this, but we seem to be mostly coming together during interesting times, specifically in the uranium market. So we are either talking at the top or we are talking at the bottom for uranium stocks. So let's hope this time is the latter, because I've had a bit of pain. But what do you think, by the way? Is the pain over for uranium stocks after the massive drop today?
My suspicion is that there was some reflexes selling around the failure of Sprott to be able to list the Sprott Physical Uranium Trust on the New York Stock Exchange. Certainly, I was disappointed, albeit not surprised. But I think that investors, as usual, have taken a very short-term view, which I think is incorrect. The Sprott Physical Uranium Trust has done a superb job tightening up the spot market, and has begun to change the structure of the uranium market by taking 50 some odd million pounds out of the spot market. They have at once cleaned off the overhang, but more importantly, set the stage for a structural change in the uranium market away from spot onto term. That's very important. When investors look at what is probably a hiatus in growth from the Spot Physical Uranium Trust, at least in the near term, they miss the fact that the most important aspect of the uranium market is simply the increasing demand for uranium relative to the supply shortage. And when people focus on Sprott, they should focus actually on Japan. They should focus on China. They should focus on the slowing pace of European decommissions. They should focus on the geopolitics of uranium and the fact that almost 40% of the world's enrichment capacity is in Russia, which presents some constraints. They should focus on the European energy dependence on Russia and the increasing geopolitics of energy supply, which favor uranium, which is to say the slavish focus on the very near term and the very slavish focus around Sprott is a mistake for investors. Now, personally, I'm of two minds, because I take a longer term focus, because I'm very confident about the direction of uranium prices over the next 2 or 3 years, and because I continue to believe that the junior uranium stocks got way ahead of themselves. The fact that uranium and the uranium equities prices are falling in price is of benefit to me. Given that I think that these things will become more valuable, I would like to see them be less expensive so that I can continue the process of loading up. I notice whenever I say this on your channel, I'm faced with all kinds of vitriol and hate from young people who have their last 7 euros invested in the space and would like to see it become 15 euros by Christmas. Those people, I guess, are my normal and natural victim. The truth is that if you invest in resources, you have to invest in probabilities, and probabilities take time. From my point of view, the probability is higher, and so the desire is to own more. And if your desire is to own more, your desire always should be to pay less. Suffice it to say, I'm a happy camper in this decline.
It's funny when you mention that, because you come onto my channel and you practically teach people how to do exactly what you're doing and then a bunch of them get mad at you for doing exactly what you've said that you're gonna do. So it's kind of funny sometimes. But I think you're right. The decline of Sprott not getting listed sort of came in an unfortunate combination with the broad market crashing, which I reckon has also started a bunch of margin calls, because there were a couple of indications of people or algorithms or whatever trading uranium stocks on margin, which kicks off more selling, and we go into this spiral, which is it's beneficial on the upside, but it's painful on the downside. And with that, I've also been thinking about the broad market crashing, and there's also two things that I've continued thinking about. One of them is maybe there's two questions actually. Is that, will the uranium stocks eventually decouple from the broad market, because the fundamentals for uranium are largely independent from the business cycle? We might be headed towards a recession or stagflation or whatever. I hope to discuss that later on as well, but the demand for uranium is going to keep growing. The pounds are not going to magically appear. So we stay in the most important fundamental for the market is still here, right? The most important catalyst, the supply and demand, is still here. But if the uranium stocks do decouple from the broad market, that would be the second question, would be, does that mean that the equities would then start following the spot price of uranium or the long term? Because if they do, then they'll have some catching up to do, because in the last 52 weeks, the equities as measured by the URNM have severely underperformed the spot price as measured by the SPUT, the physical fund. So that might represent a rather large potential move from the current rather oversold levels. So what do you make of those two questions, Rick?
Again, your question is a function of a time arbitrage. For the last 10 or 15 years, equities markets have been increasingly correlated, which is to say stocks are stocks in the near term. And the market for equities in the near term is treacherous, extremely volatile. We're seeing a circumstance where market liquidity is drying up, but increasingly the stocks themselves are moving in concert, because so many of them are driven by algorithmic buying. And increasingly, the algorithmic buying is being driven by transactions in the options market, which is to say, at the same time that the general equities market is becoming less liquid, it's also becoming more volatile. My belief, one more thing, of course, interest rates are increasing. And as interest rates increase, the cost of capital to companies increase, and the capitalized value of dividends, distributions to shareholders goes down, which is problematic in the near term for equities prices. What you see in times like this, what you see in particular when there are liquidity-driven crashes in equities markets, is that the high-quality companies recover first and fastest. The secondary and the tertiary companies, some go extinct, and the rest recover very slowly. And sadly for speculators, there's no more tertiary asset in the world than a mineral exploration company in an emerging market. So if you own a uranium junior that's exploring for rather than owning uranium in Africa, I do several, and you experience a severe liquidity squeeze in equities markets, a 2008 style liquidity squeeze, expect the pain that you have felt so far to be only a down payment on the pain that you might ultimately experience. Conversely, if you own one of the higher quality uranium stocks, and the uranium price holds in even while the general equities markets collapse, while the price quote around the larger and better uranium companies will fall too, stocks being stocks, they will come back much more quickly. Ironically, the investment strategy in a precipitous decline, if you are truly a speculator, is to buy the stocks that are down by 95 or 97%, not the stocks that are down by 50%. Because if you have 2 years and a cast iron stomach, that's where 10 baggers or 15 baggers or 20 baggers will occur. It's very difficult at the time to act rationally when you're scared to death. But that notwithstanding, I've tried to prepare people emotionally for that circumstance in hopes that they can take advantage of the circumstance if it occurs, rather than being taken advantage of by it.
When you mentioned the short versus the long term, I'm reminded of, first of all, there's a different concepts for different people, right? For some people, a year could appear like an extremely long period of time. For some people, that's the short term. And when you mentioned that, I'm reminded of your appearance on Jake Ducey's channel, where you said that we're in the 6th inning, which sort of that in combination with what you just said, they sort of shot an arrow right in my heart, because I believe that we were much earlier in that. I believe also during your Uranium bootcamp, there was some mentions that we were in the 2nd inning. But then you shot another arrow right in my heart, specifically when you mentioned the overpriced juniors, which as a hungry degenerate, as one might call itself, if they're me, that's pretty much all that I double in, right? That's pretty much all that I do. But so let me ask you this, Rick, on the serious side. I've sort of started disliking the baseball analogy, but for the sake of this conversation, if you think that we are already sort of 70% into this bull market from a time perspective, does that mean that you would expect the largest gains to be made rather soon? Because you've previously also told me that the biggest gains come to those who wait for like the 8th or the 9th inning. So the biggest gains are right around the corner, basically. Is that what you think?
That is what I think. The fact that I think it doesn't make it true, by the way. And the people who hang out for the biggest gains are the people who must be prepared to suffer the biggest losses. An interview recently, somebody threw the 6th inning analogy back in my face. And also threw back my comments about the more speculative stocks in my face, and say, here you talk this, and you bought something that was extremely speculative in the last cycle, Paladin, at 10 cents a share when it was damn near bankrupt and it went to $10. What people need to understand is that when I bought Paladin at 10 cents a share, it had a $1.7 million Australian market cap. It had a tiny market cap. You have nothing nowhere uranium pretenders right now. I'm not going to name them, but companies that are run by people who 5 years ago couldn't spell uranium. And they have 50 or $60 million market caps. There's a huge qualitative difference between Paladin, which had a uranium database from Uran Gesellschaft that had been acquired, that had been put together at the cost of about $1 billion by the German government, run by a 30-year veteran of the uranium business in a $1.7 million Australian wrapper. The difference in market cap between the junior uranium stocks in 1998 and 1999 and 2022 is night and day. Now, I have been around markets a very long time. And I believe that for those who are willing and able to take the risk, the highest returns in the tertiary, the marginal sectors, take place in the blow-off tops in bull markets. And I suspect, although I have no way of knowing for sure, that we're probably 2 years away from a blow-off top. I believe that the market that we're in started in 2018 or 2019. If you believe that the blow-off top occurs in 2025 or 2026, from a time perspective, we are in the 6th inning of a 9-inning game. In terms of the reaction of the market, we could easily be in the 3rd or 4th inning. But understand, playing the game for hyper gain exposes you to hyper risk. You don't get it both ways. One final editorial comment from an old dragon. Young people want certainty. That's a pity, because there is none. There's only probability. And probability requires time. You can have the direction of the market right, but the idea that you could get the direction right and the time right, let's just say that that is improbable.
It's someone also in the comments said that John Ciampaglia, the SPUT CEO, they would, he would agree with you. They said that he would disagree with you. I mean, because he's recently recorded saying that we're in the second inning, but this makes a lot more sense when you explain it that way.
I think John, who, by the way, is a personal friend of mine and whom I have a very high regard for, does disagree with me. I think that John looks at, in particular, the geopolitics of energy on a global basis, and also looks at the world's increasing need for baseload power of all kind, affordable baseload power of all kind. And John looks at the uranium market from the point of view of uranium's ability to meet unmet demands 20 years from now or 25 years from now, and expects it to be expressed in the market sooner than that. I would like to have the upside without having to make those very, very, very long-tailed assumptions. I look at uranium and I believe that the incentive price for new uranium supplies is going to move up from the $60 to $65 a pound range to the $75 a pound range. I also understand that the complexities around permitting, financing, and building new productive capacities means that the uranium price may well overshoot. But I don't want to base my own portfolio decisions on hope. I want to base my personal portfolio decisions on probabilities, so that the odds are, if I get a surprise, either in terms of duration or dimension, it'll be a positive surprise, not a negative surprise. I'm competing with younger speculators who haven't been through the same type of precipitous declines that I have. People who want narrative certainty when the best that they could hope for logically would be probability. And people who don't have, I think, the psychological stability in the game, because they don't have the experience, to take the volatility that we're going to experience. It's difficult when I talk to younger audiences to explain to them the fact that if they'd like to become rich, they need to own lots more of something out of favor. And the idea that they have, say, 20,000 euros invested in uranium and another 20,000 euros to invest, it's actually in their interest to see the price lower, not higher. Lower because you can spend more physical capital, having already allocated the intellectual capital that's necessary to make the physical choice. But I suspect that those same investors don't have the psychological stability that's born of study. And so they don't have the same confidence in their convictions that I do. That'll get me a lot of hate in the comment section, but that's okay.
Yeah, I think you're largely okay with getting that. You've always taught me, Rick, to sort of scale into my investments as well. Like, don't ever go all in, even if you think like, okay, this is the ultimate bottom.
There will come a time to go all in. You won't catch the bottom. Don't BS yourself that you can catch the bottom. But there will be points in time where the risk-reward proposition is so stupidly in your favor that you can't worry about a bottom. You just have to go. I'll give you an example, one that I failed on. 2 years ago, in the sort of COVID pandemic, at the same time that the World Economic Forum pandemic against petroleum was ongoing, the largest oil company in the world, Exxon, got kicked out of the Dow Jones 30. So you had very low oil prices. You had a horrific narrative around oil set by that noted energy economist, Greta Thunberg. And on top of that, you had a one-off event, which is to say Exxon getting kicked out of the Dow 30. The consequence of that is that the finest oil company in the world fell like a boulder off a bridge. It was obvious to me that the oil price had to go up or else nobody's cars would start. That wasn't going to happen. The oil price was going to go up. And I inexplicably thought that because of the narrative, the price of Exxon could go lower. This is felony stupid when you can buy the best allocator in the oil business in the world at a 13% dividend yield. Who cares if it can get cheaper? This is a very, very, very large, not just error of omission, error of commission. If your life is built around probabilities, if your life is built around contrarian investing, there comes a point in time where the decision-making process is not ready, aim, 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 aim. It has to be ready, aim, fire. So there may come a time, Antonio, in uranium or in some other commodity, where the odds are so disgustingly in your favor, where you absolutely positively have to bet big. And could they fall 15 or 20% from there? Sure. Does it matter? Absolutely not.
Can I assume from what you just told me, what you've previously said, that you're not yet at that stage where you're betting big on the uranium thesis?
I don't need to. I did 4 years ago.
Okay, fair enough.
I mean, and when I say bet big, relative to the speculative portion of my net worth, remember, I'm a 69-year-old retired guy. I'm not supposed to be doing this anymore. When you and I first started interviewing, the uranium market and the uranium stocks were felony cheap. I mean, they were really, really, really cheap. I was perfectly prepared to believe it might take 5 years to be right. It turned out I was right sooner than that. Now, as I told you, there was a point in time when some of these stocks went from being too cheap to being at least fully priced relative to the economics of the projects that they had. The narrative took over. And all of a sudden, these companies were discounting $75 uranium in a $50 a pound world. Could uranium get to $70? Yes. But does it make any sense to buy a $75 option in a $50 world? Probably not. Particularly when you could take the money from a low quality asset and put that same money in a high quality asset in the same sector that was relatively less expensive. So for me, that was a no-brainer trade. The idea that I could sell out of Amalgamated Moose Pasture, parenthetically the junior, and buy Cameco, which on a risk-adjusted basis was cheaper. That was just a trade I couldn't do. Or for that matter, sell out of a company that was looking for uranium that had a $100 million market cap and simply use the proceeds to buy the Sprott Physical Uranium Trust. In other words, take the high risk overpriced asset and substitute it for the very, very low risk underpriced asset. And I did that. And what that means from my own point of view is that the risky part of my portfolio is free. I sold enough stock that I've replaced my whole cost. I'm at what I call now the point of no concern, which is a slogan that I use to differentiate it from making a huge mistake, which is the point of no return. And I would argue that speculators need to pay attention to this whole circumstance where you bet big at a period in time where the probabilities are on your side, and you remember to harvest enough gain when the narrative becomes popular that you de-risk your position entirely.
I was going to ask you, I was preparing to ask you, when do you plan on de-risking your position? But then you told me you've already done that. So let's maybe turn this around. When do you expect to be completely out of the uranium trade, even with the money that you've left in?
That'll be up to the market. If we saw the uranium price go above 100, if the incentive price for new production is still, say, $75, you will see me greatly reduce my uranium exposure unless we see individual issues that lag, or unless we see countries which have the ability to be big uranium producers go out of favor as a consequence of domestic political instability. Let's say that the whole uranium sector was overpriced, but let's say there was domestic political instability in Namibia and Kazakhstan. It is likely that I would continue to hold the politically risky narrative companies, even though I reduced my position in the rest of the sector. What I found over time is that an industry that's generating on average 50% operating margins is an industry where you will see supplies inexorably increase, and you will begin to see fabrication efficiencies that means that consumption declines. You won't see this reflected in a quarter or a half or any period of time that's relevant to speculators at all. But it will be relative. It will be relevant to me when the preponderance of evidence doesn't favor the fact that prices have to rise. They stop rising. And the consequence of that is that when the narrative is stronger than the economics, that's the time you sell.
And that's the time you sell out of everything completely, or would you still even approach the market out?
The market will tell me.
Okay.
It really depends on how overpriced it becomes. Certainly in the pre-Fukushima timeframe, I was basically out of the uranium business. I think that the incentive price for new production in those days was $45, $50 a pound, and the price was 130. Nothing good can come from that circumstance, particularly when you saw the Kazakhs being able to ramp up production so incredibly rapidly. I hadn't understood in the last uranium bull market the incredible metallurgy of the Kazakh ISR production. And when that ISR production began to ramp up, it was very clear to me that the incentive price for that production was $30 a pound, and we were at $130 world. That's very, very, very inconvenient arithmetic for a long.
Okay, that makes a lot of sense. And I know that I'm sort of jumping on topics within uranium, but I know you don't have too much time, so sort of keep it moving. Maybe one last question on uranium here, Rick, would be that you also mentioned it at the beginning, so that's why I wrote it down. But you spoke to me at, I want to say, the beginning of 2020 or the summer of 2020, something like that. It was long before SPUT was a thing, right? And you told me that Japanese restarts were the main catalyst for uranium. That's what you were looking at. But now we have SPUT, we have SWU prices going through the roof. We have the potential to cut Russia off from delivering the uranium to the West. We have, what else we have? Increasingly improving sentiment for nuclear is what we have. There's a bunch of other things going on in the uranium market. So which one of those do you think is the mover that matters most?
In the near term, the pace of Japanese restarts. More important than any of them. And for several of the reasons that you mentioned, the winds are all in uranium sales now. The Japanese public is coming around to the point of view that they must permit Japanese restarts. Japan Inc. already wants the restarts. The circumstance that I said was a Sunday event is a 2022 and 2023 event. Mm-hmm. That's why I'm sitting here smiling. Irrespective of SPUT and the New York Stock Exchange, the structure of the uranium market has changed, and the structure of the uranium market has changed just in time to maximize the benefit that the industry will feel from the pace of Japanese restarts, which, absent another catastrophic event worldwide, another Chernobyl or another Fukushima, the pace of Japanese restarts is now inevitable, and it's imminent.
And you get that in combination with a lot of other European countries that are increasing their nuclear capacity and all those things. So
remember that increasing capacity takes 10 years or 15 years. On a net present value, it's almost a sentiment indicator, although it does mean that existing plants have to contract to get their supply done in front of those guys. What matters right now is 10 million pounds of demand a year coming out of Japan. That's not 15 years from now. It's not 20 years from now. The net present value of an event that takes place in December is infinitely greater than the probabilistic net present value of something that happens 12 or 15 years from now.